Good morning, everybody. For the next 5 or 10 minutes, I'm going to be talking to you today about one of the federal programs that we work with. Um, it's called Public Service Loan Forgiveness. It's going to take a lot longer than 5 or 10 minutes to fully understand all the tricks with the program, but the purpose of today is just to give each of you a general idea of what it is and how it helps our audience. So let's get into it. So the program again is called Public Service Loan Forgiveness. It was created in 2007 and it's intended for anyone that works full-time in a nonprofit full-time position. Examples of this can be teachers, administrators, military, law enforcement, city, state, government jobs, basically anyone working for a company with a 501c3. There are thousands of different careers that could fall under this category. So the way it works is candidates on this program are put on reduced qualifying income-driven repayment plans that they can choose from. I believe there is about 4 different options available. And when they're making these payments on this program and they're also working full-time for a nonprofit, after making a total of 120 of these payments, the remaining student loan balance and interest that they have at that time would be forgiven in full. The idea behind it is the program is designed to increase the number of full-time nonprofit employees that are out there and try to encourage them to stay in these professions long term. And if they're able to do that, they're going to have a reduced monthly payment and forgiveness of their loans after basically 10 years of service, assuming they can do it consecutively. The nice thing with income-driven repayments is that the loan balance of the candidate is usually irrelevant for what their monthly payments are going to be. I'm going to take you to a website shortly that goes over that piece. But essentially, whether someone owes 20 grand or 200 grand on their student loans, what they pay per month and what they pay over the 120-month, 10-year period is usually the same. The website that we're currently on provides an overview of everything we're talking about today. This is something that I would highly recommend each of you to take a look at. It goes over all the different FAQs that you'll commonly run into when talking with our audience, like what is qualifying employment, who is considered a full-time employment, what is a qualifying plan. It goes on and on. So I want each of you to bookmark this page up here and just have it handy because you'll be going back to it frequently as you get more and more familiar with the program. So moving forward, the program is managed and serviced by a lender known as FedLoan Servicing. They are the ones that track qualifying payments, and they're the ones that candidates would submit their application to after 120 payments have been made. Um, while it is possible to make qualifying payments with other lenders like Sallie Mae, Great Lakes, Mohella, some of the other federal servicers out there, it's recommended to get in contact with FedLoan Servicing and get your loans moved over to them as soon as possible, just to protect yourself and give you the best chance of qualifying once your 120 payments have been made. So, given the short time frame we have today, I'm going to take you guys to a website that provides an illustration of how this program works. The quickest way I get there is by going to Google. Once Google loads, in the search engine, just type in IBR calculator. And then for me, I like to use the word mobile afterward because it pulls up a more user-friendly site. There are dozens of different federal calculator sites out there. This is the one that I prefer. It'll say repayment estimator, studentloans.gov. The URL below will say studentloans.gov/mydirectloan/mobile. That's the key part. This one works too, but again, I prefer this one. So I click here. You can guide your students and your clients through the same site as well. When they get here, they're going to be prompted to either log in or proceed. To log in, they're going to need to know their FAFSA email and password. Most people I talk to don't know theirs, so for the sake of time, you can tell someone just to click on proceed. If they are able to log in, it will automatically pull up their current federal loan balance in front of them, so it makes some steps easier. But for the sake of today's training, we're just going to hit proceed. Once you hit proceed, it's going to take you to a couple different boxes that we have to fill in some information on. So let's start at the top. Let's go ahead and create a scenario that we will often hear about when talking with our audience. So the first section says your loans. Let's go ahead and add some loans here. We want to click on the gray box that says add loans with a plus sign. In this drop down, it goes over the loan type, all the different types of loans that are out there. We'll just leave it on the default direct subsidized loan for now. For the balance, let's give this person $30,000. There's no dollar signs, no commas needed. The interest rate, now that varies, and quite frankly, it's not that important either, because like I stated earlier, payments on this program have little to do with your loan balance and interest rate. So let's just call it about 6.0. That's pretty close to the national average. Once we get that in there, go ahead and click on add. And that will give us a pretend direct subsidized loan for $30,000 at 6% interest. Moving down, next question will ask about the tax filing status. They have the options of choosing single, married, or head of household. For this example, let's use head of household. Let's pretend that the person that we're talking to has a son or daughter at home. Moving on down, for box 3, it's going to ask for the adjusted gross income. So this is difficult to give an exact answer on if you're not looking at a W-2. So what I normally ask is to have them think about what their before tax income is, like what their salary before deductions, and then subtract a couple grand off it. And that's assuming that they're having some other deductions coming out besides state and federal tax. Adjusted gross income, it does give an explanation of what it is right here if you click on it. It's basically stating that things like retirement, medical benefits, 401ks, other pre-tax deductions can be taken out of your net income, everything with the exception of state and federal taxes. So if we're talking to, let's say, a teacher that's making approximately 40 grand a year before tax, their adjusted gross, if they're having health insurance and retirement and those other items coming out, they're probably in the 34 to 38 range. When doing hypotheticals, I always round high just to show the worst case scenario. So let's call it 38 grand here for someone making 40. The family size, we said in this example, this would be a single mother or father of 1. So the family size would be 2. State of residence is not that relevant. Whether you live in Alabama or Kansas, it's not going to change the numbers. The only exception to that is if they happen to live in Hawaii or Alaska. So for now, let's just leave it as Alabama. And then you would want to make sure you check the box here that says show payment estimates under public service loan forgiveness. Once that's done, you can click on calculate results. What pops up is basically a chart showing 7 or 8 different repayment plans to choose from. It gives some figures about first monthly payments, last monthly payments, projected forgiveness, and the repayment period. What you want to keep in mind here is that some of these numbers are a little bit misleading and some are completely irrelevant. For example, the graduated is irrelevant. This one's not even eligible for the public service program. The ones that are the standard, the revised pay, the pay as you earn, income-based repayment, IBR for new borrowers, and income contingent. So basically everything on here except for graduated is eligible for the 10-year, 120 payment public service loan forgiveness program. Now the first one, the standard, while it technically does qualify for the 10-year, it's not very beneficial because this one's designed to have the entire balance paid off after 10 years anyway, so there wouldn't be any forgiveness. In fact, they're paying a lot more than just the 30 grand that they owe when you take interest into account. The ones, again, we want to focus on are the bottom 5 right here. These 5 right here. And again, the whole point of the program is to basically pay as little as possible for the next decade while working full-time so you can maximize your forgiveness. So what you want to do here is try to find payment plans that have the lowest amount. 3 of these 5, the cheapest I can find is 111, and that would be for revised pay, pay as you earn, and IBR for new borrowers. So if we look at this 111, this is based off of the family size, the adjusted gross income, and the filing status. That's it. So the second column here, where it says last monthly payment, is a lot higher. This is a little bit misleading, and this is kind of what I was talking about earlier. The site tries to predict what candidates will be making as they progress in this 10-year program. And if you look up right here, it says, what assumptions do we make? You can click on it, and it will talk about this in detail. But this basically says that they assume that your income is going to grow 5% each year. So they try to predict what your payments are going to be towards the latter part of your 10 years, or your final payment 10 years later will be closer to the 237, with the assumption that you're making 5% more each year. And frankly, a lot of people that we talk to, while they would love to have that 5% increase, that's not very common, especially for teachers. Other things to keep in mind here is the payments are going to go up and down every single year, every time the person files taxes. So it will rise and fall in proportion to their income, household, family size. So in this example, if the person continues to make roughly the same amount over the next 10 years, this first column is what they will continue to pay. So this $20,303 for total amount paid that it's saying here is a bit misleading because they're factoring in that 5%. So let's go ahead and pull out a calculator. I don't know if you guys can see it on here, but if I were to take 111 times 120 payments, the total actually comes out to $13,320, about $7,000 less than what it's saying here. So they're only paying $13,000 and change over 10 years. And if they owe 30 and they're paying back 13, you can kind of put 2 and 2 together. There's going to be a substantial amount of forgiveness on the back end if they can stay full-time in a nonprofit organization while making these payments. So the reason we talk about it is because this program can also be used as a security blanket in a way for nonprofit employees that have additional academic goals. If you're talking with a new teacher that is looking to complete her master's, she can potentially use this program as a way to help fund it. The program is also designed to let nonprofit employees go as far as they want to academically without stressing about the financial investment that is associated with it. So to illustrate this, let's go back up to the top. In this example that we gave, we were talking to a single mom with one kid that already has about $30,000 in loans. Let's pretend that she were to take out an extra 20 grand for a master's program. So let's go ahead and add this to the scenario. We'll click on Add Loans again. We'll go straight to the balance. We'll type in 20,000. Go to the interest rate, 6.0. Let's go ahead and add it. Let's keep everything else the same. Click on Calculate. If we look at these numbers again, we'll see that the standard and the graduated both went up justifiably. They were paying $333 before, and now it's $555. So you'll see that $20,000 extra in student loans has upped their payments more than $200 a month, which makes sense. That's what we're used to. But if you focus on the other ones, revised pay as you earn is still at $111. So again, I'm illustrating that taking on $20,000 in loans doesn't affect what you're paying per month. This is because the $38,000, family size of 2, and the head of household filing status, those didn't change. So in this example, you take the $111 a month over 120 months, they're still paying back the same $13,320. Now, the only difference is not only will this program forgive a good amount of what they owed prior to getting a master's, but it will also fully pay for their master's. Yes, they're having to borrow federal student loans up front to pay for the program, but if they can stay in a nonprofit, they're never going to come close to paying it back. So again, I know there's a a lot of information here, and it's going to take some time to get used to, but I'm just trying to show each of you the value of why we speak to this program and how it can help people that we talk to pursue their professional and academic goals without being buried financially by it. So each of you do me a favor and take some time to further review this site. There's a lot of good information on here, as well as that public service program, the main page. Let me take you back there. Right here, it's this one. Studentaid.gov is your main domain. So take some time to get familiar with it. Let me know if you have questions. We'll be covering this again. But again, today I just wanted each of you to understand why I'm such a big fan of it and why it's something that I would highly recommend becoming very familiar with.